Why the Silicon Valley bank crash is such a big deal. What you should know about the SVB crash. Picture this: a massive fire consuming one of the biggest banks in Silicon Valley. The flames are spreading rapidly, and within hours, the bank is reduced to rubble. No, this isn't a scene from a Hollywood disaster movie. It's the real-life story of the recent collapse of Silicon Valley Bank. But why is this such a big deal, and what does it mean for the tech industry and the wider economy? Stick around, because we're about to break it down for you. Last week, the financial world was rocked by the news that Silicon Valley Bank had collapsed. If you aren't familiar, SVB is a major player in the world of technology finance, providing banking services to tech startups and venture capitalists for over 35 years. However, on March 2nd, 2023, SVB suffered one of the biggest crashes in the history of banking services, causing a domino effect throughout the tech industry. But what exactly happened, and how could such a big bank crash amidst all the new tech startups happening in Silicon Valley? Well, to put it simply, the bank collapsed due to a combination of factors, including risky investments, bad loans, and a lack of oversight. As a result, SVB's assets plummeted, causing panic among investors and customers. Confused? Let's start at the beginning. How did the crash happen? Throughout the pandemic years, SVB's services were highly demanded due to being the chosen bank for the tech sector. Early in 2020, the COVID-19 market shock caused a swift shift in consumer spending patterns, giving way to a golden age for startups and established IT enterprises. There were an abundance of deposits since many tech companies used SVB to store the cash they used for payroll and other company needs. And of course, like all banks, SVB invested a sizable amount of the deposits. But the seeds of its collapse were planted when it made significant investments in long-term US government bonds, especially those backed by mortgages. Now, to be fair, these were just as secure as houses. But the link between bonds and interest rates is inverse. As rates rise, bond prices decline. As a result, SVB's bond portfolio started to lose a lot of value when the Federal Reserve began raising rates quickly to fight inflation. But SVB would get its capital back if it could hang on to those bonds for a couple of years until they matured. However, many of the bank's clients began withdrawing from their savings as the economy deteriorated during the previous year, notably impacting tech companies. So SVB started selling some of its bonds at high losses because it didn't have enough cash on hand, which alarmed consumers and investors. The gap between when it reported that it had sold the assets to when it collapsed was only 48 hours. You see, banks are vulnerable to a surge in client demand since they only retain a part of their assets as cash. While SVB's problems are a result of past investment choices, the run was started on March 8th when the company announced a $1.7 billion capital offering. It advised investors that a gap left by the sale of its loss-making bond portfolio needed to be filled. Suddenly, everyone got concerned that the bank was short of capital. Customers began making cash withdrawals after realizing SVB had some severe financial issues. Clients of SVB often had substantially larger accounts than those of a retail bank that served both households and businesses, so of course, the bank failure was quick. The collapse of the $200 billion corporation 2 days after it declared it would raise capital made it the biggest bank failure in the US since the global financial crisis. Is this the start of a banking crisis? Now, as always, the US government acted swiftly to calm immediate fears of a widespread contagion by ensuring all deposits made by bank customers. In response to the guarantees, financial futures, which let investors make predictions about future price changes, surged in favor of the US IT sector. But there had been worries that if that guarantee hadn't been put in place, owners of SVB accounts wouldn't have been able to pay their staff, which would have had an impact on the entire economy. And now, governments and authorities from all over the world, including those in the UK and Australia, are examining their own corporate and banking sectors for SVB vulnerability. The longer-term question is whether other banks' overexposure to declining bond prices is comparable to SVB's sensitivity to rising interest rates. To counter the risk, the Federal Reserve has introduced a new scheme that enables banks to borrow money guaranteed by government securities in order to satisfy depositor demand. This is intended to stop banks from being obliged to sell securities, like government bonds that have been depreciating due to rising rates. But here's the thing. The collapse of Silicon Valley Bank is much more than just a financial blip. It's a warning sign that the tech industry, which has been booming for years, may be on the brink of a major crisis. It's true that the tech industry is no stranger to risk and volatility. Startups rise and fall all the time, and investors know that there's always a chance they'll lose their money. But with the collapse of SVB, some experts are worried that we're seeing a bigger trend of overhyped, underperforming startups, and that the tech bubble may be about to burst. You see, SVB catered to Silicon Valley, supporting startups and other such firms that conventional banks might be hesitant to support. As the economy has gotten worse, the sector has started laying off employees lately. And to make matters worse, one of its greatest backers has failed just when they needed financial support. So the implications of the SVB crash are more than significant, since it was one of the largest providers of banking services to particularly tech startups and venture capitalists. Its collapse has left many startups and investors without access to crucial financial services, putting their businesses at risk. For startups, losing access to SVB's services could mean losing out on crucial funding and investment opportunities. Without SVB's support, many startups may struggle to find other sources of funding, which could hinder their growth and ability to compete in the tech industry. While for venture capitalists, the loss of SVB's services could make it harder to find and invest in promising startups. This could lead to a slowdown in innovation in the tech industry, as startups struggle to secure the funding they need to grow and develop new technologies. Many experts say that the crash could be a sign of an impending economic downturn, which could have serious implications for the tech industry and the wider economy. As we can see, the SVB crash is a big deal with far-reaching implications. It's a warning that even the most stable and established institutions can falter, and that the tech industry is not immune to the ups and downs of the economy. So, what can we learn from the second biggest bank crash in US history? Well, for one thing, it's a reminder that every investment carries risk. It's important to do your due diligence and not get caught up in hype or trends. But more than that, it's a warning that we need to take a closer look at the tech industry as a whole. Are we investing too much in unproven startups? Are we relying too heavily on the tech sector to drive economic growth? Only time will tell what the fallout from the SVB collapse will be. But for now, it's a wake-up call for all of us to think more critically about the role of technology in our economy and our lives. What do you think about this massive bank crash? Tell us your views in the comments. And if this video taught you something, give it a like and don't forget to subscribe to stay updated on this developing story.